Hello, good morning everyone. My name is Alvina and I'm one of an executive MBA students from IPMI International Business School. So today I'm going to welcome you all to my journey of learning on corporate finance by Professor Sembel. And through this mind map, I will try to explain the process of the learning and the things that I find really useful for me to learn this subject. So as I go, these are my mind maps. So the first chapter, so we're gonna learn about the financial management. So in financial management, basically, it is an orchestration, internal and external financial resource. And from this chapter, I learned that are the 4 key things according to the Prof. Sembel about financial management. The first one is about the goal of the financial management itself, which is about value creation. So if you look at the value creation, basically it is mentioned that value is created when a company is really generate growth. So for example, the high return on invested capital, high cash flow, high return on equity, and high profit margin. So eventually having the higher cash flow, it's something that we want some company to have a value on. And the second one is about principal agent problem, in which we learn that there are 3 main problems of the principal agent problems found in the daily life. The 3 problems include the conflict of interest, the asymmetric information, as well as moral hazard. And basically, Prof. Roy mentioned that there are no bulletproof solutions to deal with these problems, but basically it's all need integrated solutions to deal with these kind of problems. And the second one, we also learn about good corporate governance. The company mentioned that they have a good corporate governance when they implement or have these 5 values, which is including the transparency, accountability, responsibility, independency, as well as fairness. The last one, we also learned from Professor Ramcharan, which is a business consultant, author, and CEO, from his book on what the CEO wants you to know about the 5 business essentials, which include cash, profit margin, velocity, growth, and customer focus. Okay, so that's the first chapter. And the second one, we also learn about the capital budgeting, which is a real example application of time value of money. So with this capital budgeting, we basically learn about how to estimate the expected future cash flow and also how to evaluate a project using the capital budgeting theory. So the overall or the bottom line is basically using net present value is a better method for project evaluation. So again, as I mentioned before, we learn about net present value, which is sort of like a present value of all cash flows. And the second one, we also learn about the internal rate of return, or called IRR. So IRR is basically the discount rate that makes the NPV 0. The bottom line is we accept the project if the IRR is more than the required rate of return. And the third one, we also learn about the profitability index, or PI. So the PI is basically we accept the project if the profitability index of the PI is more than 1. So the 3 components, which is the net present value, the IRR, and the PI, consider all the cash flows. They consider time value of money, and also they consider the required rate of return. However, the fourth one, which is the payback period, it does not really adjust of the timing value of money. So it's sort of like it sort of like ignore the timing differences. So therefore, the bottom line, as I mentioned before, is MVP is definitely better methods for project evaluation. So the third chapter, we also learn about the security analysis. So basically, the security analysis is really interesting topic because we learn about the outside and in perspective investment strategy. We learn about the information gathering, decision making, monitoring, sort of like the company, and also performance evaluation. Using the security analysis, there are 3 main things that we learn, which is the fundamental analysis, technical analysis, and risk versus volatility, which will I go through one by one. So the first one is about fundamental analysis. This is what we learn using an example of a public company. So in fundamental analysis, we learn about the domestic and global economic analysis. We also analyze the industry benchmarking, and also we learn about analyzing the company using and trying to learn about the historical trend. So this is what we learn. We learn about the intrinsic value versus the market price. And we also try to learn about the financial statement analysis when we analyze the balance sheet, the income statement, as well as the financial ratio to understand better about the company, and also the point analysis. So in intrinsic value versus market price, we learn that we make a decisions if the intrinsic value is more than the market price. Definitely is a good indication for us to buy the stocks. If the intrinsic value less than market price, we can sell or short sell the stocks. However, if the intrinsic value is equal to the market price, we can hold or fairly price on the stocks. As I highlighted before, in financial statement analysis, we sort of like also analyzing the profitability of the company using the return on asset or return on equity. We also learn about the liquidity, the activity, the leverage, the financial leverage, the market ratio, and something that really highlighted for me is definitely we need to look at the industry benchmark as well as the historical trend to really understand or to really analyze the company healthness or the financial statement analysis. And the third one, we also learn about the DuPont analysis, which is about the return on equity, which based on the net profit margin multiplied by total asset turnover, as well as the financial leverage. The third one is about the technical analysis. So in this case, we also using the same company. We learn about the momentum and versus the reversal of the stocks. We look at the trend for the past 3 years of the company and the moving average, and also a symmetric or asymmetric triangle. A part of the technical analysis, we also learn about the risk versus volatility, which is using the capital asset pricing model. We learn about the beta value, which is considering the systematic risk related to the market movement and compare it to the overall market risk. The fourth chapter, we also learn about the capital structure, which is really about the long-term source of fund, and it's all about financial structuring. So in this chapter, there are 3 main points that I would like to highlight, which is the first one is debt versus equity. The second one is about the M&M theory, or it's not a chocolate, but it's basically a Modigliani and Miller theory. And the last one is trying to learn about the optimal capital structure. In debt versus equity, it's really interesting for me because we learned that debt is really cheaper than equity. So basically what I'm trying to say is investment in equity is a bit risky versus debt. So by using of debt, it will help to lower the weighted average capital cost, and by the high level of debt, the WACC will increase, and there is a risk perception from investor. So basically, it is sort of like the bottom line is it's really better to have invested in debt compared to the equity because it's cheaper and less risky. The second one, we learn about the Modigliani and Miller theory, as I mentioned before, which is M&M theory. So in this subject, we learn about the capital structure theory, which is basically highlighting that based on M&M that in this world, there is no transaction cost, no taxes. So what they're trying to say is basically the capital structure of a company does not affect its value. However, we learn that we don't live in a perfect world. So that kind of things doesn't really adapt to the current situation. However, with the M&M theory, finally they sort of like revised and mentioning about the optimal capital structure. So there are 2 factors that actually influencing the optimal capital structures, which is the tax benefits and also the financial distress. So in tax benefits, it's also including the profitability of the company, the factors that influencing tax benefits, in this case, the tax rate and also the interest rate. Meanwhile, for the financial distress, some factors that are really influencing the optimal capital structure or the financial distress, including the volatility of cash flow, the liquidity, the GCG score, as I mentioned before about the good corporate governance, and also the Altman Z score. Okay, so finally, we also learned about some special topics in this subject, including the fraud risk management, which is basically we learn about the investment fraud. So before we really invest into something, there are several things that we have to consider, including the legality of the company, the people, the product, the contract, and the payment mechanisms. And also, we also learn about the fraud triangle, why people actually committing fraud, including some opportunities, rationalization, and pressure. And therefore, it's really important for a company to have the whistleblower mechanisms to prevent this fraud to happen. Meanwhile, we also learn about the corporate restructuring. So basically, it's about how we can stop the bleeding and save the cash flow before it really goes to bankrupt. And an interesting story is about a leverage buyout. We learned the example case is using the RGR Nabisco case about the leverage buyout. And also we learned that whether some unethical and illegal things, the interesting part is about whether greed is good. So it's just something concept that really interesting. So not all greed is good, but again, it's sort of like how to optimize things, and it's really sort of like in gray area about ethical and about legal, because ethical is something that's really sort of like a gray area. And also, we also learn about international finance. There are several things that I would like to highlight as well. The first one is we learn about the foreign exchange market. We also learn about the inflation rate. And we learn about the forward versus future market, in which that the forward is about the contract to buy or sell assets. Meanwhile, the future market is basically a specific example of forward capital, which is traded in organized market. And we also learn about the options and also the arbitrage strategies, which is basically a price discrepancies of products in different locations. So the last one, we also learn about the dividend policy. So basically, we learn that why a company should pay dividend. There are two main points that why it is important. Definitely, the first one is to get the tax benefit, and the second one, if a company really consistent paying dividend, it really shows that the company has a good performance, and it also increases the confidence of the investors. So definitely, it's not really one time of paying dividend, but also having that paying dividend consistently is the good indication of the good performance of the company. And for the last one, I think for me, it's really has been an interesting 7 weeks. And all in all, the lesson learned is it's okay to make mistakes, as Prof. Roy kept mentioning. Basically, mistakes are our teachers. They help us to learn. So that's it from me. Thank you so much for listening. And hopefully you guys would like to interest to study more about the corporate finance. Thank you. See ya.